Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Seiwan, Professor of Economics at Ewha Womans University. Professor Kim, thank you for coming on today.
Good afternoon, Devin.
Well, stocks on Wall Street were mixed overnight. Investors both hoping for a fast economic recovery, but also worried about a second wave of the pandemic. What's the story in the global markets?
Right. Starting from the end of last week, U.S. market has positive daily returns over 4 straight days until Tuesday of this week. And this boom of the market has been driven by expectations on very close economic recovery. But on Wednesday, for growing concerns on second pandemic, U.S. market ended with mixed returns between Dow Jones and NASDAQ. Dow Jones decreased by 0.65% on daily basis, but NASDAQ increased by 0.15%. And Asian markets had negative returns today, mostly due to increasing coronavirus infection in Beijing and also intensifying U.S.-China conflicts for the last few days.
Now, Fed Chairman Jerome Powell, testifying to Congress on Wednesday, said that the economic support for America's workers and businesses should not end too soon, or it could jeopardize the recovery. What do you make of his comment?
In a testimony to Congress on Tuesday, Fed Chairman Powell warned that U.S. faces a deep downturn with significant uncertainty about the timing and strength of recovery. And at the end of testimony, he really emphasized the role of expansionary fiscal policy along with expansionary monetary policy. He said that recent small improvements could be jeopardized if Congress weakens support to workers displaced and business hit by a pandemic.
Now, it was another up and down session in the Korean markets today, starting out sharply lower, but recovering some of that. The Kosdaq actually posted a gain. Tell us about the Korean markets today.
North Korea's geopolitical factor was, of course, negative impact on domestic market. But on the other hand, we can see that positive factor of economic recovery is coming out slowly. So today's domestic market is mixed between a positive return in Kosdaq but negative return in Kospi. Kospi ended with negative 0.35% on daily basis, but Kosdaq had positive 0.26 return for today.
Now, oil prices have been declining this week amid a bigger than expected increase in supply. Tell us about that and your outlook for oil.
Oil price increased for 2 days until Tuesday as economic recovery is more expected and oil production has been cut recently by oil-producing countries. But as U.S. oil reserve piles up to the highest level in history, international oil price dropped by almost 1%, which is a big drop in a single day in both of the Western Texas Intermediate and Brent markets. I believe that international oil price will be more volatile over geopolitical factors and oil-producing countries' attitudes on oil production.
Now, a release from the International Institute for Management Development in Switzerland ranks countries in terms of global competitiveness, and we now see that Korea rose in the rankings by the most in 20 years. It's now 23rd place, up from 28th. How much do you think its response to the pandemic figured into that ranking, Korea's response, that is, and what else stands out to you here?
It was a very rare good news in the middle of coronavirus pandemic recession situation in Korea. Korea rose 5 notches to 23rd place in global competitiveness ranking by a swift Switzerland Business School's annual report. So according to that report, Korea has strength in low rate of long-term unemployment, digital transformation, and research and development. But they are pointing out that Korea still needs improvements in tariffs and corporate both effectiveness and relocations, threat of business, and so on. So I believe that if we maintain our effective responses on COVID-19, our international competitiveness will be improving in the near future further.
Got it. All right, Professor Kim, thanks so much for sharing your insights today. We always appreciate it.
Thank you very much.